2 years ago, imagine Lena built a $12,000 emergency fund. Today, the account still shows exactly $12,000. She has not withdrawn a cent. There was no bank fee, no bad investment, and no hidden purchase. But if Lena lost her income this morning, that money would protect her for about 20 fewer days than it did when she saved it. The balance did not shrink. The safety did. When Lena first built the fund, her bare minimum month cost $3,000. That covered rent, basic utilities, groceries, insurance, essential transportation, medication, and minimum debt payments. $12,000 divided by $3,000 gave her 4 months of breathing room. Now those same essentials cost $3,600 a month. The rent renewed higher. Groceries became more expensive. The electric bill rose. Insurance changed. Nothing on the list became luxurious. The minimum cost of keeping her life functioning simply moved upward. $12,000 divided by $3,600 is 3 1/3 months. The same money that once covered 4 months now covers about 3 months and 10 days. Lena lost roughly 20 days of protection without spending the emergency fund at all. This is a hypothetical example, but the mechanism is real. An emergency fund is usually displayed as a dollar balance. Emergencies do not arrive in dollars. They arrive in time. How many weeks can you keep the rent paid? How many grocery trips can you make while looking for another job? How long can you maintain insurance, transportation, medication, and minimum payments before a temporary problem becomes debt? That is what the account is actually buying. The hidden problem is that most people measure the fund with the number on top of the fraction and ignore the number underneath it. Your savings balance is the top number. Your essential monthly cost is the bottom number. When the bottom number rises, your financial runway gets shorter even when the top number never changes. This is why an old savings target can become dangerously comforting. You may remember the moment you reached $10,000, $15,000, or whatever number once represented safety. The number becomes a finish line. You protect it, leave it untouched, and feel responsible every time the banking app confirms that it is still there. But the account can stay frozen while the life around it becomes more expensive. The Bureau of Labor Statistics describes consumer inflation as the average change in prices paid for a basket of goods and services. The word average matters. Your emergency fund does not cover an average household, it covers your household. If your largest essentials rise faster than the headline number, your personal emergency cost can increase faster than general inflation. In May 2026, for example, the overall consumer price index was 4.2% higher than a year earlier, but electricity was up 5.9% and shelter was up 3.4%. Different parts of a basic household budget moved at different speeds, and your personal mix may be even more uneven. A renter facing a renewal, a parent paying for childcare, a driver dealing with repairs, and someone managing regular prescriptions can experience 4 very different versions of the same economy. This creates a quiet misunderstanding. People hear that inflation is slowing and expect the old level of safety to return. But lower inflation usually means prices are rising more slowly. It does not mean the price level has gone back to where it started. If a $3,000 survival month becomes $3,300 and then prices rise more slowly after that, the new baseline is still around $3,300. Your emergency fund does not automatically regain the coverage it lost. The jar still looks full. The month became larger. This matters because emergency savings are supposed to create options. They let you repair the car without financing the entire bill. They let you handle a medical deductible without missing rent. They let you leave a dangerous job, survive a layoff, or wait for a better offer instead of accepting the first available one. The Federal Reserve's 2025 household survey found that nearly 6 in 10 adults had at least one major unexpected expense during the previous 12 months. The most common was a major vehicle repair or replacement, followed by major home or appliance repairs and unexpected medical expenses. So the emergency is not an abstract event sitting far in the future. For many households, it is a recurring category with an unpredictable date, and rising costs can hit the fund twice. First, they shorten the number of months the existing balance can cover. Then, when an emergency actually happens, the event itself may cost more. A repair requires more labor. A replacement appliance carries a higher price. A temporary loss of income leaves you paying a more expensive monthly baseline while no paycheck is arriving. That is why a fund can look unchanged and still be less capable. There is another layer that makes this easy to miss. People naturally anchor to round dollar amounts. $10,000 feels like a real object. 3.3 months feels less satisfying. A dollar target is visible, memorable, and easy to celebrate. But safety is not a round number. Safety is a relationship between resources and obligations. A $15,000 fund may be enormous for someone whose essential month costs $2,500. It may be narrow for someone whose essential month costs $5,000. The balance alone cannot tell you which person has more breathing room. This does not mean the money was saved incorrectly. It does not mean cash is useless. And it does not mean an emergency fund should be pushed into risky investments just to chase inflation. The purpose of this money is access and stability. Earning interest in a safe, accessible account can reduce some erosion. But the deeper correction is not finding a magical account. It is measuring the fund in the unit it was built to provide: time. A useful number is your emergency runway. Take the amount of liquid savings you have genuinely reserved for emergencies. Then divide it by the current cost of one bare minimum month. Not your normal month. Not the month when everything goes perfectly. And not a punishment budget where you pretend food, transportation, or medication disappear. Use the honest minimum required to keep the household functioning. Include housing, basic utilities, essential groceries, insurance, necessary healthcare, minimum debt payments, required childcare, essential transportation, and the bills that would continue even after income stopped. Leave out optional shopping, travel, entertainment, extra debt payments, and contributions to long-term investments. Those may matter in normal life, but they are not what determines whether the lights stay on during an emergency. Suppose your emergency savings are $15,000 and your honest minimum month is $3,750. Your runway is 4 months. Now suppose a lease renewal, insurance increase, and higher grocery costs move the minimum to $4,250. The fund still says $15,000, but the runway is now about 3.5 months. That half month is the invisible shrinkage. Once you know the runway, choose a target that reflects your actual risk. Someone with 2 stable incomes, low fixed costs, and strong family support may need a different runway from a single-income household with dependents, variable work, health costs, or a job that takes months to replace. The point is not to obey one universal number. The point is to stop using an old dollar target as proof that nothing changed. Then reprice the runway whenever a major essential expense changes, or at a regular interval such as every 3 months. This takes only a few minutes. Update the bare minimum month. Divide the current fund by that number. Compare the result with the amount of time you intended to protect. If the runway is shorter, you now have a clear gap instead of a vague feeling that money is less safe. Maybe the gap can be rebuilt gradually with a temporary increase in saving. Maybe a bonus or tax refund restores part of it. Maybe one large fixed cost deserves attention because it is doing more damage than several small purchases combined. Or maybe the target must be lower for a while, and the honest decision is simply to recognize that the household is carrying more risk. Clarity does not instantly create cash, but it prevents a false sense of security. It also changes the emotional meaning of adding money to a fund you thought was finished. You are not starting over. You are not failing to hold the line. You are updating the amount of time your savings can buy in the life you have now. That distinction matters. Without it, someone can do everything that looks responsible, keep the account untouched, and still feel strangely anxious. The banking app says the fund is intact. Daily life says everything costs more. Both messages are true, and the conflict between them creates the feeling that the numbers cannot be trusted. The numbers can be trusted. They are simply answering different questions. The account balance answers, "How many dollars are here?" The emergency runway answers, "How long can these dollars protect me?" The second question is closer to the reason the money exists. So look at your emergency fund again, but do not begin with the balance. Begin with the life it has to support. What does one honest, bare minimum month cost today? How many of those months does the fund actually contain? And how does that compare with the protection you thought you had when you first built it? Your emergency fund may not be gone. It may not even be smaller. But if the cost of staying afloat has risen, the distance it can carry you has changed. Same cash, less safety. The good news is that invisible shrinkage becomes manageable once it is measured. You do not need to panic, abandon the fund, or blame yourself for an economy you did not control. You need an updated map, because the real value of emergency savings is not the number that sits still in an account. It is the time, choice, and breathing room that number can still buy. Which essential expense has shortened your financial runway the most?